All right, everyone, it's 11 a.m. and we are ready to get started. Thank you for joining us today for the overview of the Consolidated Appropriations Act of 2021. So just when you thought that you were going to wake up January 1st, 2021, with everything changed, you find yourself 4 days later sitting in another COVID-related webinar. So I guess sorry about that. Welcome to 2021. Not much different so far. But the good news is there's a lot of really helpful information in this new legislation and really some great relief for businesses that have been impacted most by COVID in 2020 and continuing now into 2021. So just a few items that I wanted to cover before we move on. Everyone has been placed on mute. You will receive a follow-up email with a copy of the webinar. We will put a recording of the webinar on our COVID-19 page. And you can stay updated and register for any upcoming webinars on our COVID Information Center. We have done tons and tons of legislative updates and many, many webinars, which are all still listed there if you want to go back and learn more about some of the legislation that's actually kind of resurfacing again with this new bill. You are welcome to do so. And then if you have any questions, I'm actually providing my email address. I may regret this later, but I really just wanted to be able to give you direct contact so that if you have any specific questions, some of this gets a little complex, especially when we get into those employee retention tax credits. And if you have questions, by all means, whether you're a CTR client, many of you I work with already, or if you're a prospective client, feel free to reach out and I'm happy to give you any information that I know. So this is me, Bridget Escobar. I'm the president of CTR Payroll. For those of you who do not know us and you are just received our webinar invitation through our marketing emails, thank you for joining us. And we are based in Pittsburgh, Pennsylvania, but we have clients all over the United States. And we just focus on providing really awesome hands-on payroll services, as well as great technology for HR and many of the other HRIS technology that our clients like to take advantage of. So let's get into the Consolidated Appropriations Act. So $9 billion of COVID-related relief. What's included? We'll get into what's included, obviously, in this webinar, and there's a whole lot there. I'm focusing on what I believe is most important to our clients, employers. What's not included, interestingly enough, is state, local, and tribal government funding. That was a hot topic that was in the initial bill. It is not in this bill that was signed by President Trump. Liability protection against COVID-19 lawsuits. That was another highly contested item, beneficial to employers that didn't make it into this signed legislation. And then federal student loan forbearance was not included. So what we're going to talk about today is, first of all, the FFCRA leave updates. I remember only a few weeks ago having a webinar telling our clients, here's what we think you should do, because as of today, we don't see that this leave is going to be extended. And we talked about different ways that you can notify your employees and different leave that you can offer. And now here we are today, and it has been extended, but with an interesting twist, which I will cover. We're also going to talk about some additional PPP updates. So we all know that there's PPP round 2. I'm sure you've heard this. We'll cover what the qualifications are for that. But there were some additional up to the actual round 1 PPP and some information on some changes there that may help employers who have not actually applied for forgiveness yet, give them a little more flexibility of what can be included. And then a big topic is the expanded employee retention tax credits. This is a little more complex and there's a lot to cover there. And this is going to be very helpful for employers who were especially heavily impacted by COVID and the shutdowns. And then the last are changes to health and dependent care FSAs. That actually wasn't covered in a lot of the, if you've read some summaries or attended a few webinars, I haven't seen this covered extensively. So just wanted you to make aware of some additional changes there. And that's pretty much our agenda for today. So let's dive right into the FFCRA leave extension. So it has been extended. You can now choose to offer the EPSL, so that's emergency paid sick leave, and the emergency FMLA leave. You can offer that through March 31st, 2021. But the big key here is that it is optional. And if you choose to offer it, you will get the tax credits. So if you're continuing to offer this on payrolls through March 31st, you will still get those tax credits. What's important here, in the third bullet point, we note, employees will not get new hours to use. So they don't get their buckets replenished. They can just continue to use the unused portion of their original allotment, which remains for 2020. So I think that is, I guess, at least beneficial, because the government doesn't really anticipate this to continue, hopefully not much past March, and hopefully this will not need to be extended in any way if we will have less and less employees out for this type of leave. So an example here is Johnny was entitled to 80 hours of emergency paid sick leave in 2020. He used 60 hours of that leave in 2020. Johnny would have 20 hours of remaining EPSL to use until March 31st, 2021. Pretty easy there. So there's something important that I want to note, especially for our own clients, but even those of you who are listening in today that are not clients. So those wage limits are still in place. And if you didn't remember, I wanted to recap what those wage limits were for the different types of leave. So for CTR clients, those wage limits are going to reset with the calendar year. So that bucket goes back to zero. So it's important that if you do have employees that are kind of like right in the middle, so they took some leave, like in the example of Johnny in 2020, and they have a balance to take in 2021, that you're making sure that you're reviewing to make sure that they haven't hit that wage limit. So let's talk about the wage limits real quick, just as a refresher. So the first thing we're going to talk about is the emergency paid sick leave. So remember, that's the 80 hours of leave that you can give to employees. It's paid at 100% of their regular rate of pay, up to $511 per day, or and 5,110 in the aggregate. So that goes for leave types 1, 2, and 3. And really, these categories are leaves where an employee is experiencing symptoms, they've been advised by a healthcare provider to quarantine, or they're subject to some type of quarantine or isolation order. So it's related to that employee's own sickness. Now, the good news on the wage cap is, really, if you think about it, we're talking $5,110 in the aggregate over a 2-week period. If we were to take that and annualize that wage, it's roughly $130,000 a year. So the majority of your employees probably will not, if you're just paying them at their regular rate, they're not going to hit that wage cap in that 80-hour span, but just important to note, and just keep an eye out for those that would be over that annualized amount. So then with the next type of leave, this is leave for caring for an individual who's subject to a quarantine, or caring for a child whose school or place of care is closed. And unfortunately, in Pennsylvania, at least, we have had another round of school closures in the past month. So this would come into play. Now, this leave is 80 hours, but it's paid at 2/3 the employee's regular rate. The daily cap's 200 and the aggregate's 2,000. So it is important that you're making sure that these employees are not hitting that wage cap. You're making sure you're capping them out. And then the next slide is just a refresher on the emergency FMLA. So they get total of 12 weeks. The first 10 days is unpaid. Why is it unpaid? Because you can substitute the emergency paid sick leave. So you already have the 80 hours of paid leave paid on the last slide that we talked about. So you can substitute the emergency paid sick leave, then they get an additional 10 weeks, and then the total pay is not to exceed $10,000 in the aggregate for those 10 weeks paid at 2/3 of the employee's regular rate of pay. For those of you on here who are CTR clients, we have a report that you can use. You go to reporting, client reports, and then you can run the report for the beginning of when the FFCRA was enacted. So that would be April 1st, 2020. And you can even extend that out to March 31st, 2021. And then if you look over here on the right, that's showing COVID sick hours. And it's showing that this one employee, 12 here, has 24 hours and $246. So they're not anywhere near the cap. So this report gives you just a nice way to just look overall where your employees are in case you were concerned about anybody hitting that cap. Of course, if you do have absence codes in our system, and we did put an absence code with a bucket, you can automatically see on their screen how much of those hours they're decrementing on their leave bucket. So I want to get to some frequently asked questions. I did have one client ask me, I think about a week ago when this first was extended. They said, well, could I offer the emergency paid sick leave, but choose not to offer the emergency FMLA leave? And really their predicament is that they don't have the type of business where employees can, work from home with their kids being home while they're doing homeschooling. So these employees that have children where their schools are closed, they physically are not working and they are taking advantage of this leave. But the impact is just so significant on the business because so many employees are out that it's getting to be really just a terrible negative impact on their business and just having people to be able to work. So the question was, could we offer one but not the other? So I just looked at the Department of Labor FAQs as of yesterday afternoon, and I did not see an answer to this question, but we're going to give you our answer. And so our answer is, since the FFCRA leave is now optional to employers, we believe that it is reasonable to assume that employers may choose not to offer the EFMLA leave, but may choose to offer only the EPLSA, the emergency paid sick leave, the 80 hours. However, we do recommend that you monitor the DOL FAQs for further clarification on this topic. So I would continue to monitor those, and we will let you know as soon as we get more information. We'll put out a legislative update so you know if anything has changed from that standpoint. But we do think that's a reasonable assumption considering it's optional. Now, next question was actually on the Department of Labor FAQs. They only posted 2 yesterday. And one of these was, I used 6 weeks of FFCRA leave between April 1, 2020 and December 31st, 2020, because my child care provider was unavailable due to COVID. My employer allowed me to take time off, but did not pay me for my last 2 weeks of FFCRA leave. Is my employer required to pay me for my last 2 weeks if the FFCRA leave expired? And the answer, of course, is yes, because that leave was taken in 2020, and the employee was entitled to be paid for that leave per the FFCRA. It was not optional, and so you would be required to pay that leave. It also noted that the Department of Labor will enforce any claims made for qualified unpaid leave within the statute of limitation, which is 2 years from the date of the alleged violation, or 3 years if the conduct alleged was willful. So they're doubling down on the fact that if you didn't offer that leave in 2020 and an employee qualified for it, that you could be penalized for it. Now, I wanted to note also for employers, we've had some clients come to us, especially, in the month of December, and they said, I missed some of your webinars. I didn't see the legislative updates, and I was not aware that some of the leave that I've been giving to our employees would have actually qualified as this FFCRA leave. I could have received a tax credit for this. Now what? Well, the good news is that we can go back. If you let us know, we can go back. We can do amended returns for the quarters where you could have qualified that leave. I think we just need to be smart about it and decide whether it's worth it. I mean, if it's only one employee or a couple employees, the amount of credit that you get might not be worth the hassle. But if you do have a lot of employees, it could be, fairly significant and worth us going back and trying to get a refund and get those credits. So on our last webinar, I touched upon the Pittsburgh COVID-19 sick leave ordinance. And because CTR is headquartered in Pittsburgh, we thought it was important to at least cover that. I do want to note to our clients and others that have joined us that could be in other areas of the country, there are lots of local ordinances now that are popping up with these types of leave, emergency paid sick leave, or even just sick leave in general, at the city level, and then also even at the state level. So if you're one of those employers that says, you know what, since it's optional, I'm not going to extend the FFCRA leave. I don't care about the tax credit. I need to continue on business as usual. Do keep in mind that just make sure you're aware of whether your city or state does require paid sick leave, because you may need to continue to offer some type of leave if that is the case. So this was signed into law December 9th. It applies to Pittsburgh employers with at least 50 employees. And we already covered this. It's basically kind of a repeat of the FFCRA leave. Employees who are experiencing COVID symptoms are eligible for this type of leave. Very, very similar. I believe this was signed into law December 9th because of the uncertainty as whether the FFCRA was extended. So we did a fact check with Pittsburgh. We did email them and ask them, hey, now that the FFCRA leave is extended, do our Pittsburgh-based employers have to offer the emergency COVID sick leave for Pittsburgh on top of the FFCRA? And the answer in writing from the city of Pittsburgh was no, you do not. You may substitute the FFCRA leave if you're offering that optional leave in place of the the emergency sick leave. Now, this is not to be confused with the Pittsburgh paid sick leave that went into effect in March of 2020. That's a totally different sick leave. This is just a separate emergency sick leave for COVID that they just enacted December 9th. So the good news is that if you're offering the FFCRA leave, you can offer that instead. Here's just a quick overview of some additional states with paid sick leave or even have enacted emergency sick leave. So just be aware. All right, getting into the PPP loans, and I thought that this slide was pretty interesting on what is the state of the union on PPP loans as of the end of 2020. So $657 billion was allocated to PPP loans from the CARES Act. $523 billion was used. There were 5.2 million loans provided to businesses. So that leaves 20% of that original allocation was unused. Only 11% of companies have actually applied for forgiveness so far. So that leaves over 4 million forgiveness apps that have not been submitted. And then 87% of the loans were under $150,000. So the majority, most of these are to small businesses and they're under $150,000 in the loan amount. So these statistics obviously show why this next change was made in this latest legislation. So this 358S application is a simplified application that businesses that had loans under $150,000 can now use. So the borrower, all you have to do if you fall into this bucket, you fill out an application that's no longer than 1 page. You include the number of employees that you were able to retain because of PPP, the estimated total amount of the loan spent on payroll costs, and the total loan amount. We should expect to receive the form. It was within 24 days of enactment, so around the 3rd week of January this month. And this applies to loans made prior, so all those outstanding applications that are still there, and then also future loans. So it makes sense, right? This is a lot of work for banks and a lot of work for the SBA. This really makes it a lot more efficient and in the ability to process loan forgiveness and collect these applications. So some really important additional changes. They have now expanded the use for PPP funds, which is crazy, right? So here we are all the way into 2021, and now they're going back. This applies to both your prior PPP loan as well as the round 2 loans. So if you have not applied for forgiveness yet, you could take advantage of these. We're still waiting on guidance from the SBA for those of you that have applied and may want to alter your loan forgiveness application to include some of these things. So let's go through them. Covered operations expenditures, payments for business software or cloud computing services that facilitate business operations, product or service delivery, the process, payment, or tracking of payroll expenses, HR and billing functions, or accounting or tracking of supplies, inventory, records, and expenses. So for example, if you're using our software, CTRs, to track your payroll expenses, for your PPP loan, which many of you have been doing, this is obviously would be a covered business expenditure that could be included in your loan forgiveness application. Covered property damage. So many businesses were damaged, unfortunately, in some of the big cities across the US due to the vandalism and looting that was going on throughout the summer of last year. And if your damages were not covered by insurance, it could be included. Covered supplier costs. This one is a little bit confusing. I think we need some further clarification from the SBA. Expenditures to a supplier of goods that are essential to the operations of the entity at the time at which the expenditure was made and made pursuant to a contract or order in effect at any time before the covered period or with respect to perishable goods in effect at any time during the covered period. And then the last piece is covered work protection expenditure. So this is your PPE. These are all of the adjustments that businesses have had to make in additional expenditures to make sure that their business is complying with CDC guidelines. All of those plastic, what I'm drawing a blank here, separators that you see when you're going to pay at the register, or restaurants who have had to expand their outdoor dining in order to provide more space to space out their tables or allow people to continue to eat outdoors. Ventilation, filtration systems, all of those things would be covered. Remember that the limitation that 60% of the loan must be used for payroll costs is still in place. But the reason behind this, I believe, is they're really trying to, for those businesses that were hard hit in 2020 and moving forward, they're allowing them to find ways to spend the money to count some of the additional expenses other than just payroll. And you'll see why that's important once we get to the expansion of the employee retention tax credit, because now those wages that you were using to apply for loan forgiveness for the PPP could now be reallocated to the employee retention tax credit, and you could get additional tax credits on those wages. So if that's what you're doing, you're going to need to be strategic and start including some of these other expenditures when applying for PPP loan forgiveness. So another change is to the covered period. So they had a rule in place. So remember, they came out with the covered period and it was 8 weeks. And everybody was freaking out because they said, how on earth are we going to spend these payroll costs in 8 weeks? And it was a challenge. So everybody was excited when they extended it to now a 24-week covered period. And we have processed several clients' loan applications. And what we are seeing is that all the clients are meeting the payroll cost requirement by extending out to the 24-week period. So you could use either if your loan was made before June 5th, 2020, you could use either the 8-week or the 24-week period. If it was after June 5th, 2020, you had to use the 24-week period. The new rule now allows borrowers to select any covered period between 8 weeks after the loan origination date and 24 weeks. So you could use 10, 11, 12, whatever the amount of weeks that it took you to hit those payroll costs is what you can use. Now, what's also helpful is it appears that this change will also allow borrowers, if you read the act, in the definition of the covered period, but we may need a little clarification from the SBA there. It appears that it will allow borrowers to apply the same covered period for your FTE count for the covered period and the wage reduction calculations. This is important because under the prior rules, even if you spent the payroll costs, it took you 10 weeks or 11 weeks. If you had wage reductions, if you had employees that you reduced their wages, you get a penalty for that. You had to apply that to the full 24-week period, even if you only spent the money in 10 weeks. So it appears that now you can just apply it to whatever period that you're using. But I think we do need a little clarification from the SBA. So another clarification is that employer-provided group insurance benefits other than medical are also eligible for payroll costs. This was very vague. I mean, they never really defined what group healthcare costs were. So now they're defining it. Group, life, dental, vision, or disability fall within the definition of forgivable payroll costs. I know some of our clients were already throwing dental and vision in there. I don't think that there's any issue. This is retroactive anyway. So, I think the way that it was reading is that, you could interpret it to include those. They've just clarified it. Remember, if you are not tracking some of these amounts in our system, please let us know. We do have that PPP loan forgiveness report that you can use that will help you fill out every area of that application. But we will need to add those amounts in the system so that we can also include that in the report for you. And then business, this is a huge one. I'm sure many of you have already heard this because it was a big deal. Business expenses paid with forgiven PPP loans are now deductible. So, and I am definitely not a CPA or an accountant, but the long and short of it is that the original CARES Act did not allow the deductibility of expenses covered by a forgiven PPP loan. So for all intents and purposes, this loan that you received and you received forgiveness on was taxable. So you would have had to set aside some money this year to make sure that you covered those taxes. So now this eliminates that tax bill for you, and you're getting basically the full benefit of that PPP loan and the full forgiveness that you hopefully received. So another change, the EIDL advances no longer reduce forgiveness. So the prior rule said that you had to put that EIDL advance in and subtract it from the total loan forgiveness. It's now reversed. And if you already applied for forgiveness, we believe that you should be able to amend it. We just need some clarification from the SBA. So another interesting topic, the Act requires the SBA to issue guidance to lenders within 17 days of the enactment of this Act to provide a process for borrowers who returned all or part of their PPP loan so that they may actually reapply. So this goes back to, I think this may have been May, June time, probably June timeframe. So the SBA, really started to issue some rules that were cracking down on that requirement that you need to prove that you needed this loan in order to continue to operate your business. And some employers that were, they had revenue reduction, but it wasn't necessarily a lights out situation, or, they felt that they could make ends meet, were concerned about, hey, am I going to get audited? Am I going to be penalized if I keep this loan? So the SBA provided a period and they said, okay, well, you have up until this date to return the loan amount. And it was stressful for a lot of business owners. They weren't sure what to do. And I do know of some businesses that returned their loan. Well, then the SBA issues new rules and they say, oh, well, any borrowers that had a loan for under 2 million, the necessity safe harbor is in place. So, we're just assuming that it was necessary. Well, that was after some businesses had already returned the loan. So, it was kind of a mess. And so they're asking the SBA to issue some guidance to fix this. So this may provide an opportunity for some of those businesses to go back and claim the loan. Maybe some of their competitors did and they didn't, and they have a significant disadvantage. So I suspect we'll see some more guidance. I mean, they have to issue it, but we'll see some more guidance as well as to those businesses that are seeking to reapply. And then they allowed some additional borrowers who were not originally eligible, borrowers in bankruptcy. There are some additional rules around that we're not going to cover today, but some borrowers in bankruptcy can apply. And then also they added PPP loan eligibility for Section 501c6 nonprofits. So this would be your Chamber of Commerce, real estate boards, professional leagues. There are some guardrails, must have less than 300 employees. And then there's some additional restrictions on lobbying activities that we're not going to get into. But if they are engaged in a lot of lobbying efforts, there could be some limitations there. So let's get to the PPP second draw loan. So what is it? It added $285 billion for the PPP second draw loan. There are some different rules around it. It's geared toward smaller businesses that were impacted more by the pandemic. The max loan amount is $2 million. So it's limited to businesses with 300 employees or less. You must have used the entire amount of the first PPP loan, or you will use such amounts before you can apply. And then this is the big thing. You had gross receipts during any 2020 calendar quarter that were at least 25% less than the gross receipts from the same quarter in 2019. So if you were not in business for quarter 1 through quarter 3 of 2019, then it says you can compare quarter 4, 2019, so this last quarter, to quarter 1, quarter 2, or quarter 3 of 2020. If you were not in business in 2019 at all, but you were in business before February 15th, 2020, you can compare second, third, or fourth quarter 2020 to first quarter 2020. It does appear that you have to still meet the necessity test, just stating that the loan is necessary to support the ongoing operations of the business. But we're not really sure what the rules are around that. I mean, we did have that safe harbor in place for businesses that had loan amounts of $2 million or less. So assuming that safe harbor is still in place, then this is not as much of an issue for businesses. But we will get some additional rules and clarification from the SBA on round 2 of the PPP. Remember, the SBA, with the prior, the initial PPP loan, they are required to actually provide their rules. And so we expect to have the rules governing this second draw of the PPP. And they are required to provide guidance within 10 days of enactment. So we should see something hopefully by the end of this week, which we will update you as soon as we receive that. So let's get into calculating the loan. It looks very much like the first, up to 2.5 your average monthly payroll. And then you can use, if you're applying for the loan, the 1 year period prior to the date that you are applying, or you can just use calendar year 2019. And then the max loan is $2 million. Now, if you're a first-time borrower, it is still $10 million. So PPP round 2, there is a special calculation for restaurants and hospitality. And this goes with the theme of this legislation in helping out the businesses that were impacted most. They will get to draw more money on this loan, 3.5 times their average monthly payroll. And again, it's the same calculation the year prior to the date you apply, or 2019. Again, same max loan amount of $2 million. And here's a listing of, it's NAICS code 72. So that's going to be your hotels, your bars, your restaurants, your caterers, all of those types of businesses that really have been impacted. This is something that hasn't really been discussed a lot on some of the webinars, but I think it's important. I do believe we have some clients that may actually be eligible for this. So there are grants for shuttered venue operators. So that they are offering 15 billion in grants to live performing arts organizations, museum operators, motion picture theater operators, live venue operators or promoters. They must have gross earned revenue of any calendar quarter of 2020 that is more than a 25% decline in gross earned revenue during the same period in 2019. And then the last requirement is that they can't be shut down. I mean, they have to be intending to open when they're able to, or be open. So let's get into the expansion of the employee retention tax credit. And really, this is a major change that will help those businesses that were significantly impacted. So let's first look on the left-hand column here. We have the CARES Act. This is the prior 2020 law. So what happened with the CARES Act is the major issue with the retention tax credit was that you couldn't take a PPP loan and the employee retention tax credit. And all we heard on the news and all we heard the politicians, the president talk about was the PPP. So the employee retention tax credit really didn't get any attention except for businesses that did not qualify for the PPP. And I will tell you that we did have a handful of clients that were not eligible for the PPP, either because maybe they were too large or they were a type of nonprofit that wasn't eligible. And we did process a lot of retention tax credits for those clients. And I was pleasantly surprised in the amount of the credits these clients were claiming. Some of these mid-sized clients with 100 employees were able to claim credits in excess of $100,000. And that was under the new rules, or under the old rules. The new rules actually expand the amount of credits that you can claim. So it's definitely worth paying attention to the retention tax credit this time. So under the old calc, you could qualify for 50% of qualified wages. The cap per employee for all of 2020 was $5,000, so up to $5,000 per employee. There was a different definition for qualified wages for employers with over 100 full-time employees. Then for the new Appropriations Act, so the new retention credit starting 2021, it's 70% of qualified wages with a $7,000 cap per quarter. So that means this goes into effect. It's in effect for the first 2 quarters of 2021. So you get $7,000 per employee for first quarter and then another $7,000 for second. That's a max credit of $14,000. So much more significant. Eligibility for the credit. So business is fully or partially suspended due to COVID, or before you could qualify on the gross receipts test. So if you had gross receipts of less than 50% of the same 2019 quarter, you would qualify. Now it is business is fully or partially suspended. So that hasn't changed. Or gross receipts less than 80% of the same 2019 quarter. PPP borrowers were not eligible before in 2021. They are, but there is a clarification there that we will cover that you can't double dip for both. And then employer size thresholds. Employers of any size are eligible, so that's important. But there was a distinction between whether the employer had over 100 full-time employees in 2019 or under 100. The employers that had over 100 full-time employees in 2019 they couldn't claim near the amount of tax credits than the ones under. That has changed. The threshold now is 500 full-time employees, and I'll go over what the differences were on how that was calculated. So the prior retention tax credit, it ended December 31st, and then the new one starts January 1st, and it extends through July 1st, 2021. In the prior act, the government organizations were not eligible, and now certain government organizations are under the new employee retention tax credit. So I want to cover Section 206 of the Taxpayer Certainty and Disaster Relief Act. This is a portion of the new legislation that serves a very, very important purpose. It allows companies with a 2020 PPP loan to retroactively claim the credits. So if you got a PPP loan and you wouldn't have been able to claim those retention tax credits in 2020. Now, if you meet the qualifications under the 2020 rules, you can qualify. So remember, the credit for 2020 could be claimed from March 12th, 2020 through December 31st, 2020. So that's your time frame. And then you can claim the tax credit for that entire period that you meet the eligibility requirements, but you can't claim it on the same wages that you either will use to apply for PPP loan forgiveness or you already have used to apply for PPP loan forgiveness. What it doesn't change is the computation of the tax credit for 2020. If you're going to go back and claim the credit, you still have to use the 2020 calculation method. So let's look at what that was. Remember what I said on the first slide, it's 50% of up to $10,000 of wages. So that is $5,000 per employee. That's it for the wages between March 12th and December 31st, 2020. Remember, I said there was a distinction. If you had more than 100 full-time employees for 2019, you may only claim credits for wages paid to employees who were not providing services. So an example would be, remember we had the, what was it, 14 days to reduce the spread that the federal government enacted. And I think it was roughly around that March 12th, March 13th timeframe, the last 2 weeks of March, where everybody had stayed home and many states had orders in place really limiting which businesses could be open. So, you figured this is 2 weeks, we'll let these people go home, we'll continue to pay them even though they're not working. If you had over 100 full-time employees in 2019, you could claim the tax credits for those employees for those 2 weeks. And we could go back and we could calculate those and we could claim those credits to see if you could get a refund on that. Now, if you had less than, and this is a typo here, I can fix this before I send it to you. This should say less than 100 FTEs for 2019. You could claim the credits for all wages and healthcare costs paid to the employee, whether they were working or not. So if they were continuing to work, you brought them back, you could continue to claim the credits. And below is the way that this calculation works. So we have employees A, B, and C. And so during an applicable quarter where this employer was eligible in 2020, employee A had $8,000 of wages, employee B had $10,000, employee C had $15,000. So how do we figure this out? We're going to take 50% of those wages, but remember, it's only up to $10,000. So that employee C that had $15,000 wages, we can only claim 50% of the 10. So 50% of 8,000 plus 10,000 plus 10,000 equals 14,000. So this employer would have a $14,000 credit. And then what would happen is on the next, that employer could just claim that credit. In 2020, they could just claim it on their next payroll. It would deduct from their taxes and they wouldn't have to pay that tax amount for their next payroll. So what was the eligibility? So in 2020, you had to be fully or partially suspended by a government order. The IRS, I have a link here. I'm not going to go over all the scenarios. We don't have time today, but they provide very specific scenarios identifying what types of businesses would be eligible in certain scenarios. Examples they provide: a restaurant that was at a reduced capacity, so they couldn't seat as many people. a restaurant that had dine out only, a restaurant that had to space their tables 6 feet apart and could have less people, a business that had a supplier that was basically shut down and they were unable to get crucial supplies for their business, which impacted their business. Those are just a few examples, but it's really important to go to this link and read whether you were fully or partially suspended at any time in 2020, because you may be able to go back and claim credits for those periods. And then the second one was experiencing a 50% reduction in gross receipts. So even if you weren't fully or partially suspended, if you experienced a 50% reduction in gross receipts when compared to the same quarter in 2019, you could claim the credit. I can tell you that not many businesses were impacted to this level. There were some. And if they were impacted to this level, they probably were already fully or partially suspended by a government order, and they were qualifying under number 1. So let's go through a potential example. All right, so we will need, and I'm going to just put a disclaimer here, we need some further clarification by the IRS, and based on last year, I do feel that that will be forthcoming. So example here is foodie restaurant laid off, and by the way, this is an example of how we would retroactively apply the credits. So foodie restaurant laid off its employees on March 13th, 2020. From March 13th through April 30th, there was a government order restricting in-person dining. Foodie restaurant obtained a PPP loan on May 1st and used a 24-week covered period to spend its payroll cost, or to spend the loan proceeds on payroll costs. Foodie restaurants used the payroll costs from May 1st, so that lasted for 24 weeks through October 16th. And they used those funds to obtain loan forgiveness. Also in 2020, there were the following additional government restrictions on foodie. Restaurants were limited to 25% capacity through September 21st. Restaurants were limited to 50% capacity through December 11th. Restaurants restricted to outdoor dining and takeout through January 4th, 2021. These aren't realistic dates, but they're rough dates and something that was similar that happened here in PA. So since foodie restaurant was fully or partially suspended by a government order from March 13th through December 31st, 2020. So really, since the pandemic started, foodie has been impacted in some way. This restaurant may go back and claim the employee retention tax credits for employees for all periods of 2020, with the exception of May 1st, 2020 through October 16th, 2020, as those payroll costs were used to apply for PPP loan forgiveness. Now, this is just a potential scenario, but there could be, once we get some clarification, a way for foodie to maybe apply for more. So here are the questions that we still have unanswered. What if an employer, so say foodie received a PPP loan of $500,000 and foodie is using a 24-week covered period, and that total amount was $800,000. So they well exceeded the payroll cost. Remember, they only need to spend 60% on payroll costs. They've well exceeded that, and they've well exceeded the full amount of their loan. So these wages, as we know, because foodie was pretty much shut down the whole year since the pandemic, they also would have qualified for the employee retention tax credit. So would the employer be entitled to claim the employee retention tax credit on the wages over and above the 500? Because remember, they had 800,000 of wages that they spent during that full 24-week period. Or would foodie be able to go back if they already applied for loan forgiveness, which some restaurants have? Would they be able to go back and amend their forgiveness application and just use the 60% and then try to use the 40% on all the additional expenses that they've now opened it up to in this new legislation? We do need some more clarification, because for these businesses that qualify for both, it's going to be very strategic in how you allocate these funds so that you can maximize the amount of money that you receive from these programs. So how do you retroactively claim the credits, right? The ship has already sailed. You've already paid your taxes. Now what do you do for 2020? Well, the Act does not clearly say that. It does state that an employer who has filed a payroll tax return before the date of enactment of the latest relief bill may elect, so that's this bill, and it was enacted the very last week of December. It says it may elect to treat any applicable amount as an amount paid in the calendar quarter, which includes the date of enactment. So that would be the fourth quarter of 2020. Well, at this point, we're already closing out the fourth quarter. We still don't have the official rules on, how we can treat those funds that could have been included in your loan forgiveness period, or how we can finagle those amounts. So it seems pretty difficult to try to rush and get all those in the fourth quarter at this point. Here is what we presume. We presume that you will be able to have CTR go back and file amended returns for the quarters of 2020 that the credit would apply. Why do we presume this? Because we do this all the time as a payroll company. We are able to go and we are able to amend returns for any prior quarters. So we would apply the credit to the amended 941 for the quarter that it would apply for in 2020, and we would be able to mark that as a refund so that you could get that money back. But again, we do need some additional guidance from the IRS. What's important is that if you are a CTR client, feel free to reach out, and I do have my email. Many of you already have it. If you need help just trying to strategize and figuring out how to do this, we are more than happy to help you and work with your CPA so that we can come up with the best strategy. We do have some excellent reports that you can use. So let's talk about the new rules for 2021, because some of you have been sitting here going, gosh, that doesn't apply to me for 2020. But you may be able to get in under the new rules. So the covered period's January 1st, 2021 through June 20th. Remember, we said 70% of qualified wages. So the amount goes up. It's essentially $7,000 per employee per quarter. We know the rules have been relaxed. So that whole 100 full-time employee threshold no longer exists. It's now 500 full-time employees. And if you're under 500 full-time employees, it just applies to your gross wages that you pay to the employees and their health insurance expenses. Those all would be factored in as qualified wages. Again, same rule on whether you were fully or partially suspended by government order, you would qualify. That hasn't changed. The second one has changed. If you're experiencing more than a 20% reduction in gross receipts when compared to the same 2019 calendar quarter. So how do you look at this? To make the gross receipts test, you look at the immediately preceding calendar quarter. So that would be calendar quarter, you could look at the fourth quarter of 2019 compared to the fourth quarter of 2020. So you could look at, let me rephrase that. You can look at the immediately preceding quarter, which would be quarter 4 of 2020. You compare that to quarter 4 of 2019. If there is a drop of more than 20%, then you may be eligible then to claim this credit in 2021. Now, how do you go about claiming the credit now and moving forward if you qualify? So option 1, which we believe is the best practice and what we have been doing for our clients that have been claiming it in 2020, we provide a CARES Act Employee Retention Tax Credit report. This report will provide you with your total credits. It gives you the information that you need. Then you do a payroll preview in our system, you run the report, it gives you the estimated credits for that payroll. And then you take the credits, you enter them on the business credits tax screen, and this will immediately offset your payroll tax liability. It gives you immediate cash flow, that payroll in your pocket. You don't have to ask the IRS for it. You just keep it. Reduce your taxes, you keep it. Now, there's one caveat. This was just enacted a week ago. We are waiting for our software development team to update that employee retention tax credit for the new 2021 calculations. That will be coming fairly shortly. don't worry about the fact that you probably have a payroll this week or a payroll next week or the week after. If it takes 2 weeks, 3 weeks, it doesn't matter. You're not losing those credits. We can go back 3 weeks, we could go back 4, whatever, to go back and calculate those credits, and then we can apply them to the next available payroll and every payroll thereafter until you exhaust those credits. Now, option 2 is something new within this legislation. Employers with fewer than 500 FTEs may elect for any calendar quarter to receive an advance payment of the credit for that quarter in an amount not to exceed 70% of the average quarterly wage paid by the employer in 2019. Now, this is an estimate, so we would need to be reconciled against the actual credit. This is a good option for an employer that they need the extra funds now for cash flow purposes. They're gonna request the advance credit, and then we would have to do a reconciliation. And we don't say that's the best option, just because if you don't have a serious cash flow issue, it's better just to calculate it up front and we can go ahead and apply it to payrolls. The other reason why we aren't as wild about this is because it's year end and the IRS is extremely busy. We have no idea what kind of support mechanism or what they have in place to issue these advances. So if you apply for it, it very well could take 6-8 weeks. We just don't know, or it could be right away. So that's why we like to just kind of take control of it and just apply it as we go to your payrolls. Remember, if you plan to get a second draw PPP loan, it's important that you plan that the payroll costs can't be used both for the retention credit and the PPP. So you have to be strategic about when you want to apply the payroll costs to the employee retention tax credit. So if you're confident you're qualifying for the first quarter, you're probably going to want to reserve the first quarter to using those payroll costs for the employee retention tax credit. And then once we get the rules on the second draw PPP, hopefully you can kind of finagle it where your covered period is going to start really kind of after the period that you would qualify for those employee retention tax credits. So it really does take some planning and consideration. This is a snapshot of that report. The CARES Act 2020 Employee Retention Tax Credit Report is there now if you want to go back and see if you qualify. And I'd be happy to talk with you. Again, here's my email. This report does need a little tweaking. So if you are running that just to see whether you qualified for 2020, we just need to make a few adjustments so that you can run this and do your calculations. So feel free to email me and reach out and we can help you. So the last update, we have just 2 more updates and we are running up against our hour and we will wrap this up. So the FSA optional updates. So there is an option for employers that they may permit FSA participants to carry over any unused benefits or contributions remaining in their health FSAs to plan years ending in 2021. The unused amounts in 2021 may be carried over into plan years ending in 2022. They've also allowed for the extension of grace periods. So for plan years ending in 2020 or 2021, an employer may extend the grace period of up to 12 months where the participant could incur expenses against the unused amounts. But you can't have both the carryover feature and the grace period. This applies to the dependent care FSAs as well. And then also for post-termination reimbursements for an employee who stops participating in an FSA in 2020 or 2021, the employer may permit the participant to continue to receive reimbursements from unused benefits or contributions through the end of the plan year. If you want to make these changes, you do have to amend your plan. And then the very last item that we're going to cover today is the payroll tax referral. They have changed the repayment timeline. So this is not to be confused with, there was a payroll tax deferral for the employer portion of Social Security tax. This deals with the employee Social Security tax. So remember that President Trump had it wasn't officially an executive order, but something very similar that he put in place and they were calling it the payroll tax holiday for employees to basically, it's not like they didn't have to pay taxes. They're basically kicking the can down the road. The problem with it is that the taxes had to be paid back by April 30th, 2021. And then the big issue was that employers were on the hook for paying this money back. Because of that, we didn't have, I mean, I honestly can't recall of a single client that actually, it was optional. So I don't know of any client that actually allowed their employees to do this. But if you are someone who did, the timeline for repayment has now been extended to December 31st, 2021, but the employer continues to be responsible for repaying those taxes and getting that reimbursement back for the employees that you allowed to kick that can down the road and not pay the taxes during that short period in 2020. So that is all we are covering today. Like I said, there's a whole lot here. I think the theme of this is really just focusing on those businesses that were the hardest hit by COVID. And this really does provide a lot of additional relief to those businesses. So it's a good thing for those employers. If you do have, I'm sorry that we didn't have time for questions today. It was just a lot to pack in an hour. But if you would like to send your questions to me, I have my email up here. I'll leave that up here for a few more minutes. And thank you very much for joining us today. Have a wonderful afternoon.